In this video, I explain what is a home equity loan or also a home equity line of credit and how much can I borrow from my bank against my home. A home equity loan allows me to borrow against the available equity in my home. What is home equity? In this example, let's say I have a home that has a property value worth $500,000 and I have a first mortgage balance of $350,000. That means I have equity available to me to borrow against of $150,000. My property value of 500,000 less my mortgage balance of 350,000 gives me available equity to borrow against of $150,000. Today, banks rarely let people borrow all their available equity in their home. Generally, banks cap the amount of equity they'll allow you to borrow against up to 90% of the value of your home, or 85% of the value of home, or 80% of the value of your home. In this example, let's say the bank had a maximum loan to value that they will allow me to borrow against of 85%. So the first step in calculating how much I can borrow is to multiply my property value times 85%, which is $425,000. So in my example, now that I know the bank's maximum loan to value I can borrow against is 85%, and I calculated the 85% loan to value in my property at $425,000, the next step is to subtract my first mortgage balance from the max loan to value. So in my example, my first mortgage balance is $350,000. So my max loan amount I can borrow from this bank is $75,000. The 425,000 max LTV of 85% less my $350,000 first mortgage balance equals a max loan of $75,000. Now, can't borrow more than that, but I can definitely borrow less than that if I don't need the full $75,000. Home equity loans are also called second mortgages. So remember, I have a first mortgage, or what we also call a primary mortgage, of $350,000. So assuming I took out the maximum I could borrow on a second loan, that would be $75,000. So I have a second loan worth $75,000. My new equity in my home has now been reduced to $75,000. So to calculate my equity in my home after my second mortgage, of course, I would subtract the balance of my first mortgage and the balance of my second mortgage from my total property value. You have now been approved for a home equity loan. Most banks offer two different type of loan products. One, a line of credit. This is similar to a credit card where you can borrow as little or as much as you want. Interest rates are typically variable. And there's an installment loan. Think of a auto loan where you have fixed monthly payments. The interest rate is fixed for the life of the loan, and 100% of the loan is dispersed at the loan closing. I have another video that goes into greater detail on the differences between a home equity line of credit and a home equity installment loan. The repayment terms for this loan are generally between 5 and 20 years. So you'll find loan terms much longer than a traditional automobile loan, but shorter than a traditional 30-year mortgage. So these longer terms will make the monthly payments more affordable, which is one thing that's very attractive about home equity loans. Keep in mind, a home equity loan is a mortgage. It is considered a second mortgage, but that doesn't change the fact that this is a mortgage that the bank will put on your home and file with your county. If you do not pay your loan back per the agreed upon agreements with your loan terms, the bank can foreclose on your property, and they have in the past. So be careful. This is much different than a credit card, which is unsecured, or an auto loan in which the vehicle, your car, is the collateral. In this case, your home is the collateral to this loan. I hope you enjoyed this video explaining what a home equity loan is. I have another video that explains in greater detail the differences between a home equity line of credit and a home equity installment loan. Please subscribe to my channel. I have many other topics on all areas of personal finance. Thank you very much.